to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities, the only place where you come to learn how to take apartment buildings and turn them into amazing communities. I am your host, John Brackett. I have another great guest. His name is Bill Ham. So Bill's been a guest before. Now he's back with also a new book, which we're going to hear about. So Bill, I'm going to let you introduce yourself. You know, I think, you've been on the show before. We've talked through some really cool things. So, please share your background for our audience and, let's get right into it.
Absolutely. Yeah. I appreciate you having me on again as well. And I've been in real estate about 16 years now. I started off with a duplex in 2005. So I was a corporate pilot by trade, came out of school, learned how to fly airplanes, figured out that I was really actually a terrible employee and didn't want to have a job anymore. So I learned how to do real estate, spent about a year or so studying, reading books, just kind of getting comfortable with all that. Closed my very first deal, which was a duplex. And with one duplex, $300 cash flow a month and $10,000 saved up, I walked away from the aviation career, went into real estate full time. Made a lot of money, lost a lot of money, gotten really beat up, had some great deals, had some losses, been out here for 16 years doing it. So survived all the ups and downs. I've been through all the market cycles. I've seen the good times and bad times, and I'm still here through all of them. Built a large portfolio, started off early in my career, really doing a lot of creative financing. And that's sort of what we talked about last time I was on the show is creative financing. I had just written.
Remember that?
Yeah, Creative Cash. That was my first book. And so now I have come back around and written a second book, and that's called Real Estate Raw. That book is the 101 on how to build a real estate portfolio, basically, a multifamily real estate portfolio.
Okay, cool. Well, let's dive into a little bit about the book. Okay, so when you talk about it's the book to build portfolio real estate. Share some of the highlights, right? So, we have a fairly diverse audience. We have some folks who get into this business, some seasoned operators, investors on the LP side, and then, some folks that are placing capital. So talk a little bit about the book. If you can share maybe some of the high points that you feel are relevant to the audience, that would be great.
Sure. Yeah. The book really covers, it starts off as if you know nothing about real estate. So it's a step-by-step process for building a portfolio. It starts off simply and then moves to the complex. So whether you're, brand new to real estate or you are more experienced, you have a portfolio, there's something in there for you because it kind of, like I said, starts off very basic and then goes complex. One of the big things is really picking a market, learning how to choose a market, learning how to get started. And that's one of the big things that I see a lot of people, they don't get started because they're not really sure what the first step is.
Right.
They just don't know, what should they be looking at deals or should they be raising money? And then they're not sure about the market. And then how do they close? And so they get confused and then they never really get a straight answer on how to get started. And so they kind of either waste a lot of time or never actually, get going into real estate. So this book is a step-by-step kind of start from scratch. What do you need to know? Step number one, and it starts off with how to choose a market, and then once you've chosen your market, then I show you how to go in and start getting deal flow from the market, right? Because there's only two things you really need to know in real estate. And that's that you need deal analysis and deal flow, right? You need to know what a good deal is. And you just need to look at a lot more deals than everybody else. That's it. Right. So this book is to show you exactly both of those aspects, how to find good deals, how to analyze them, what is a good deal, and then how do we get them funded? How do we go out and pay for these things? How do we get private money? So it kind of covers all of that. And that's what I say. It starts off simple and then winds up very complex. So there's something in there for everybody.
So let me ask you this. So once the reader starts getting deal flow, mm-hmm. right? They learn how to analyze a deal. They start getting deal flow. Where do you think the next requirement is for them to dig in to start, having success, right? I mean, obviously.
Yeah, deal analysis, that's the key, because if you don't know what a good deal is, then you're not going to know when you see it, right? And what is a good deal? That there's no one straight answer for that. And that's why we see deals trading all throughout the market. You may look at a deal and you think, gosh, that's the worst deal in the world. That's never going to sell at that price. And then all of a sudden you see it sell at that price and you're confused. Like, wow, how did somebody come in and buy that deal at? I looked at the numbers and it wouldn't cash flow. It's a terrible deal. Well, what you have to understand is there's lots of different methods for analysis and lots of different reasons people buy. And that's why there's no real one size fits all answer. What is a good deal? We start with the question, what is your cost of capital? And what do you pay for money, right? Well, we know if you're going to go to the bank, the first amount of money you're going to pay is the interest rate. And that's going to be on 70, maybe 80% of your deal. So we know that cost of capital. The second part is the down payment money. Where does that come from? Is it your money? Is it money that you're going to go out and syndicate? You're going to raise from private investors? So we have to kind of look at what is the cost of all this. Private money is obviously going to be whatever return the investors want to make. And we look at it from that point of view and say, okay, well, then a good deal is something that makes more money than it costs me to buy and then costs me to get into. A good deal is something that obviously makes more money than I need to give only to my investors. I want to make cash flow as well. So that's kind of a very short answer as to what is a good deal. And I show you kind of how to go step by step and look at each individual deal and to decide, is this a good deal for you? Because it might be a good deal for somebody who has a lot of cash, but maybe if you're trying to, use leverage or other things, maybe not such a great deal. So I kind of go through all of that. And once you're done, you really understand the metrics of deal analysis.
Okay, cool. So, man, I think you bring up some really good points in that, you talk about the cost of capital, right? Something that rarely is discussed when investors are looking to enter the market. And in many cases, folks that have been doing this for quite some time. But then again, you are, one of the things you touched on was that people are buying for different reasons, right? And so what one person may see as an okay opportunity, someone else may see as a better opportunity, because it may be that their cost of capital is a lot less, right? And consequently, they can get a better return on that money. But it can be a couple other reasons, right? And there are a lot of ways to influence cost of capital. So talk a little bit about that. Talk a little bit about the cost of capital and how you were influencing your cost of capital to be able to get into more deals. Because the less expensive your money is, right, the more competitive you can be. But
exactly.
There are a lot of ways.
Kind of give people the example. I say, look, if I came to you and said, hey, I'll give you $1 million to go buy some real estate with, and all I want is a 3% return on my money, do you think you could go find a deal that would give me 3%? Of course, everybody's like, yes, of course. Right. Well, that's obviously, I don't want 3%, but it makes the point that, wherever the return is sets where deals start and stop. And so if I came to you and said, well, I want 10% cash on cash or cash flow return on my money, okay, that's going to be a little more difficult in multifamily. But if I said I only wanted 3%, then that's fine. What if I said I have a bunch of money and I'm afraid of inflation and I just don't want to lose it? See, now we're talking about capital preservation, not capital creation. And sometimes when groups have a lot of money, home office, larger buying groups have lots of capital. Sometimes they're putting that stuff into tangible assets like real estate, not even so much for cash flow. As long as that thing breaks even, they're fine because they know it'll appreciate someday and they're not losing capital. So that's very hard to compete against someone who's purchasing real estate like that. So you kind of have to understand. Yeah, go ahead.
But that's kind of an interesting concept, right? But man, there's a lot of risk when you're playing that game, because if the asset takes a hiccup, okay, like assets do for a couple different reasons.
Absolutely.
COVID's a great example of that. Now you can get into a scenario where your thesis is break even and ride the appreciation model. But COVID has proven that that's probably not always the best approach. So
correct.
In what scenario though have you seen people make a purchase predominantly for an inflation hedge where they're breaking even? I haven't seen that. And I'm not in a lot of those conversations, but yeah, go ahead.
Not an hour level. but at an institutional level, I've seen people doing things more of that nature. Where I have seen that more, it may be not exactly that strict where they could just care less if they make no cash flow, but I have seen it a lot more in actual foreign money coming over. Foreign money that's coming over to America that's typically leaving an economy or a nation where they don't feel that the money is safe in that particular economy. We see some of that from South America. We've seen some of that over from Asia, where investors are saying, hey, I just want my capital in an American asset. And that's really their number one concern for return is my money safe? Is it in dollars? Is it an American real estate asset? Okay, now let's talk about cash flow, and so they kind of were checking those large boxes first. And
yeah, okay, so now that makes sense, right? When you're
right.
talking about FX, when you're talking about foreign exchange,
right,
it makes a lot of sense because if the value of their currency is declining, right, and so they're not so much chasing appreciation, but they're trying to hedge against the value of their currency decreasing. But here's the thing: now you get to play both sides, right? Because you're selling out, say you're selling out of the Filipino peso, you're selling out of the Filipino peso, you're buying the US dollar, right? You're riding appreciation up. Filipino peso appreciates a little bit, but not as much as the US dollar. So now you come back when you sell out of that asset and buy more pesos. Now I see that game being played quite a bit.
Exactly.
Yeah.
Two other groups that I've seen that'll tolerate lower cash returns, and these are more of the unicorn kind of investors when you can find them, but someone who has done very well in stocks and someone who's done very well in crypto. Both will go liquid and not be that big of a concern for cash flow. I've known some people that had phenomenally successful investments in crypto, getting in early, that kind of stuff. And we're more interested in just getting out of crypto and parking it into real estate. So you never know what somebody's motivation is. And so that's where I kind of talk about in the book, is showing you how to look at deals from all these different angles so that you know when to be competitive, when you're not competitive, and when you're going up against something else that's going to be hard to bid against. And so that was something I struggled with early on in my career. I thought everyone bought real estate for cash flow, and I thought everyone was analyzing the deal in the exact same manner that I was, with the exact same numbers that I was analyzing, and that's not true. And so I would see a lot of deals come and go that, I thought these people must be crazy paying that price, and that's not necessarily true. They just had a different cost of capital.
Yeah. That's a really good point. Well, for the investor that is playing in the $2 to $5 million space,
right?
Maybe
like most of those.
$2 to $10 million space, right? That's kind of the sweet spot. What else are you seeing out there right now? And how does your book apply?
Yeah, I teach a lot and I have lots of students. And so where I am seeing the majority of people close deals right now is somewhere in the 20 to maybe 50 unit space, sort of sub 50, above 10, direct to owner. That's where, just giving short advice, that's where I see the majority of the best deals being done, is when people have some sort of direct to owner contacts, or doing some sort of mail campaign, cold calling, whatever the case. They have some sort of direct to owner system that they've set up, and they're running that system on a regular basis, and they're targeting that too big for single family people, too small for the big commercial people size property. And there's the least amount of competition in that range. I'm going to say maybe 10 to 50 units. So that's where I see the best deals. The majority of the competition lies within the larger assets, 100 plus units. And again, you're now going up against very large groups that have very low cost of capital, that are flush with liquidity from other investments. And that just makes it difficult for the syndicator. But I also believe that the market's about to shift. I also think we're not looking at an upcoming 2008 crash or anything like that. I'm not a doomsday sayer, but I do believe we are currently in the middle of a market shift, and we're going to see some substantial cooling off going forward, not necessarily in prices, but in deal flow and in hold time. Those are the two things I think we're about to cycle through heavily.
So elaborate on that. So deal flow, and hold time. So elaborate on those two things.
Yeah, one, I think we're going to see we have already seen so many transactions that it's making deal flow hard to come by, because everybody has bought this asset last year, 2 years ago. They went out, they got Fannie Mae debt.
Right.
long-term debt, this kind of stuff. So we're seeing a lot of transactions, and that's just going to pull inventory off the market for a little while. That's going to kind of keep prices somewhat up. But at the same time, returns are starting to get to a point that the assets are not really making much more sense from a cash flow perspective and a syndication perspective in a lot of cases. Why everybody's looking for value add and doing deals like you do. But, just plain old coupon clipping deal, let's buy this asset, own it, and operate. The prices have compressed the returns to a level that I feel is not competitive with other asset classes that we can invest into. Crypto, stocks, heck, a government bond will make more money than some of the prices that people are asking for real estate out there. And so what I see is a leveling off of the price while we get the rents actually to exceed the cap rate there, decompress the cap rate a bit. So someone is going to have to hang on to one of these things for a little while, be a landlord, operate, raise the rents, and actually decompress this cap rate to see returns. And so I think that's going to kind of cause a little bit of a leveling off in the market for a little while, but it'll also create opportunity.
Hey, I really appreciate you sharing that. I think that's a good, good analogy. So what you're saying is, which makes a lot of sense, right? Which makes a lot of sense because, essentially what you're saying is that all the value has been purchased. The value has already been purchased. And so the only way where it's going to make sense to do more buying is if there's an additional value there to buy, right? And so once rents exceed, right, the current level, equilibrium, we're going to use that term. So once rents exceed, once rents go beyond where they are today, right? So tenants are willing to pay more for rents go up, and consequently there's some value added to that asset, right? So that makes a lot of sense, man. So you really think that right now rents have gone as far as they can go, at least for the next year, 2 years?
I don't know if I would necessarily say they've gone as far as they can go. I see a lot of yes, the answer is yes on some properties, but certainly not on all properties everywhere. So yes, some properties have been maximized. Some people have taken the rent to where the rent needs to go. And no, you can't, get blood out of every stone out there. So no, I'm not saying every single property has infinite rent growth. Some do. My message is to be careful in your analysis. So I'm not saying, you can't buy value add, you can't find real estate, you should buy. I'm not saying any of that. I'm just saying now is a time that we should be cautious. We should learn our skills in underwriting and not over project our deals, just banking on rent growth to generally save us. Because yes, there are some properties and there are some areas where I think the rent growth might start to level off. Yes.
What's really interesting, just so to give you kind of an example of this conversation, right? So I was talking to a buddy of mine who is he's a lender, agency lender. And I was calling him one time, man, to get some data, right? I said, hey, I'm going to run this by you. I'm looking at this deal. I have data, but it's limited. Are you able to, give me X, Y, and Z? And so we're getting into this conversation, and he told me, he goes, you know what? I actually looked at a deal out there, and interestingly enough, it was the fourth time that deal traded. And he said, we decided to pass on it after number 4, right? Because they didn't want to be last one in, man. Which
financial
which made a lot of sense. So it's really interesting. And he said that that's been happening quite a bit. And this was now almost 6 months ago, maybe 5 months ago. So it appears that you're assessing the same thing, huh?
Yeah, and here's the other side of that coin. Debt always controls the market. So I can give you my opinion. It's irrelevant. I'm not writing the checks. That individual's opinion is gold because debt controls the market. And so when you start to see lenders,
debt controls this market.
Debt controls every market, right? He was a gold, right? So, and this is one of the big things I've kind of told people is you can always predict a shift in the market by watching your lenders' behavior and attitude. Watch their underwriting. As debt starts to tighten up on criteria, the market will start to downshift. And it's not always about interest rates. Think everybody thinks, the interest rates are what control it. That is some of it, yes, but some of it is the attitude that lenders have about the market in general. And when we see lenders start to get cold feet, they'll just start tightening up all the other criteria, lowering the loan to value, things of this nature, and increasing reserves. That's where you'll see the market cool off, because they'll start to turn the faucet off a little bit. So watch your limit.
Bill, sometimes though, don't you think that lenders are a little bit reactive, right? So
absolutely.
Something will blow up and then everything tightens up.
Yeah, absolutely.
Right. So there's no barometer on, hey, get ready because this is coming. It's usually an explosion somewhere.
Usually, but
the spigot starts to tighten.
Yeah, but here's the thing though: if the explosion happens every 8 to 10 years on the clock, then it's just a market cycle. You know what I mean? And something always causes the market to cycle. So what? The market always cycles. So whatever it is this time, it's COVID. It was the stock market thing last day. It was the mortgage crisis last time. But before that, it was savings loans. Whatever. Who cares? It's just something, and it's something every time. So it's actually quite predictable. Your market cycles run about 8 to 10 years. And there are other parameters, and I go through all of this in the book. But there are other parameters you can pay attention to. And if you learn to kind of read the financial tea leaves here, let's call it the debt tea leaves, if you can learn to read those kind of
the debt
predictions. Yeah, you can read the debt tea leaves.
Analogy, man.
I made it up. I just made that up. You never heard it. I just made it up.
Bill Ham, the debt tea leaf whisperer.
There you go. Yeah, exactly. The debt whisperer. I like that. So yeah, but if you can kind of read some of these signposts, it's really not that surprising, and you can kind of predict things coming. And so that's just it. Just watch your lenders. Conversations just like you had with that individual right there. That's somebody somewhere who's deciding if somebody gets a mortgage or not, and they just said they have that opinion. And I agree. When they see these properties trading, people are not going to want to be left without a seat when the music stops. They're holding that financial hot potato.
So can you talk a little bit about debt driving markets? Because I just got onto this conversation this morning, and this is the summary of the conversation. Okay, we were talking about cash versus debt and where the value is. And my comment, I said, well, it depends on what country you're in. Here in the United States, where, in this case, I want to say now like 80% of our GDP, 70% of our GDP is being driven by debt. It makes sense to own a lot of debt, right? Yeah. As long as that debt is driving assets that are producing more cash flow over the cost of that debt.
Right.
Because here in the United States, we influence our markets with debt.
Right.
Influence our markets with debt.
Yeah. And so, I think you should own debt, not be in debt.
Say that again. I'm sorry.
I think you should own debt, but not be in debt. Right?
Okay, so
I want you to be in debt to me, but I don't want to be in debt to you.
So, but this is a really important conversation, right? Because there's some people out there that really, really understand this, and there's some where they're starting to, and there are others that, you talk about this and this concept is completely foreign. But in the world of real estate,
right,
where it's really a debt-driven market, can you explain the benefit of debt, right? Why is debt so important, and why would you want to own debt in this industry, especially here in the United States?
Yeah, I think that technically speaking, on a macroeconomic level, that debt is the only real currency. Cash is not anything anybody should be worried about, and cash is not king. Debt is the real currency, and that's why nations trade in debt. But that's a very large conversation, a very deep conversation we get into. But yeah, debt is the actual value in the world, and debt is the actual tangible asset in the world. Not real estate and things like that. But that's a tough conversation to have. But yeah, I think that debt is always what you want to own. You again may not yourself want to be in debt, but yeah, debt is the greatest of all currencies, global and local and otherwise.
So why, man? Why?
Cooperation.
Okay, elaborate on that, because that's a great point.
You got to understand what money really is, right? And I used to teach this in our economics classes when we would teach real estate. I'd ask the class, what is money? And everybody always say, oh, it's a form of currency. It's, unit of measurement, blah, blah, blah. No, it's just cooperation. That's it. Because think about it. If if I want you to work for me or you want me to work for you, whatever, and we take money out of that equation, it's just two people actually cooperating. So that's what economy really is. It's the function of humans cooperating with other humans. And when you understand that, then you don't necessarily need cash. And that's the entire basis. Let me go back to my book. I keep talking about my books, but creative financing. That's the whole basis of using creative financing, is to understand that cash isn't really worth anything if you can get someone to agree/cooperate with you. So what is debt? It's another function of cooperation. So cooperation is the real value, getting people to do what you want them to do. And that's why I say, cash is fine, but it's worthless unless you get somebody to take it. It doesn't do any good just sitting around in cash. Somebody else has to agree to accept and exchange that cash. And if I can get you to agree with me by any other manner, then I don't really need cash. I mean, it's how I built an entire real estate portfolio when I was dead broke. It's just really good at getting people to agree with me. It didn't have anything to do with money, because I certainly didn't have that. I was willing to do work and solve problems.
So, that's a very difficult conversation, right? Because I don't.
That's what I was like, that's a really deep rabbit hole.
I don't agree with how you. I don't agree with exactly how you position that, right? I mean,
sure, good.
But however, I see, I can really appreciate the conversation. I can really appreciate the conversation. Yeah. I don't necessarily believe, though, that debt is a form of cooperation, because money has to go out from somebody, right? If I lend you money, I'm giving you my cash.
Yeah.
And so technically we're not cooperating. You just owe me money.
Right. But if you didn't give me the cash in the first place, cooperation, I wouldn't owe you anything.
But here's the thing, though, that cash went to you based on a criteria that I have, just like a bank, right? They're not going to wake up one morning and be like, hey, I'm just going to give everybody some money.
Totally agree.
Yeah, they have to be qualified to receive that loan based on the criteria, right? So
absolutely,
they're giving money away. You and I do the same thing based on who is more likely to pay us back.
Right, but they're still agreeing through that criteria to cooperate with you. Look at it this way: the people who are cooperated with the most become president, and the people who are cooperated with the least go to prison. Right? There's your two extremes. You either voted into presidency or you go to prison. Those are your levels of cooperation in the world. And then we have everything in between, which is money and debt and blah, blah, blah. So those are your wide end extremes. You see what I'm saying? But debt is absolutely a form of cooperation. Now, does a bank cooperate with everyone? No, of course not. They're choosing who they cooperate with. It would be silly not to, but it's still a function of cooperation. So you see, the key is to become valuable so that you always have something to trade. If I'm valuable to you, and
I agree with. And so
okay, right. So I'm valuable.
That's what I've
got something to exchange with you. Yeah. I don't need money.
Yeah. So that's what I was going to touch on, right? Not so much cooperating with debt, right? But being able to position yourself for cooperation because you have a skill that someone wants.
Right.
Right. And so you want to increase your income, man, refine your skill. Right.
Absolutely.
And at that point, you have demand. And when you
still have to go out and trade it.
I'm sorry?
You still have to go out and trade the skill.
You still have to go out and trade it, but
cooperation.
If you are really, really good at something, and there's demand for that skill, it's much easier to trade something that's in demand, right?
Absolutely. But there's still that connection of trade. So to put it like this, take all of your skills and go sit on a deserted island. Good's that now. Take all your money and go sit on a deserted island. It's completely worthless. It's only when someone else agrees with it that there's some value there. Now, if you can eat it or something like that, then yeah, maybe it has value in your deserted island.
The same thing holds true, right? If you're on a deserted island and I lend you $1 million, the best you can do is buy some coconuts and a spear gun.
If there was somebody to buy them from, right? Yeah, but if there's nobody to buy those from,
or try to make money.
Yeah, make it right.
Hey man, well, this has been a really awesome conversation.
Yeah, I appreciate it.
Tell us a little bit about your book. Talk a little bit about your book.
Yeah. So both of them are available on Amazon. It's called Creative Cash. If you're looking to use creative financing, some of the stuff that we've been talking about, I go through a lot of stuff in there. It's called Creative Cash. The second book that I just released is Real Estate Raw, and that's also on Amazon. That's the soup to nuts of how to build a real estate portfolio. And you can also check me out at realestateraw.com. I've got a lot of some free information, got some training courses on there. got some free videos to get you started with real estate and a couple other things you can check out. So yeah, check me out at Real Estate Raw. And
Awesome.
if anybody wants, what's that? Go ahead.
I said really awesome, and always great to have you on the show. Always great to
Appreciate
have
it. Yeah, and I'll give everybody my email if they want to reach out to me. It's super simple, bill.ham@bpgmail. That's Bravo.
Sounds great, bud. Well, hey, we are at the end of our show. I want to appreciate you, man, for being on. The conversations are always great, which is why we invited you back, and I want to wish you continued success. Bill, what is the one question that you have for me that you think can bring some value to our audience and yours, for that matter?
What's the one question for you? Yeah, that's a good one. What can I ask you that's going to bring value? Yeah, how do we reach more audience? That's the key. How do we get our message out to more people? So that's why I'm talking to you, because you got to be the one to get the message out there. So we gotta have a broader reach, because I think you're doing good work. And I think we gotta reach more people. So how do we get more viewers? That's my question.
We're doing it. We're doing it.
I know, that's it. Make more great shows like you're doing.
It just takes time, and nothing great, man, happens overnight, right? But
absolutely,
if you just keep doing great things consistently, that's how it happens.
I appreciate you having me
so
back.
Great things consistently. How's that?
There you go. That's a good answer. I like that consistency. There you go.
Awesome, man. Well, hey, bud.
Yeah,
thanks again. Great to see you. I want to wish you again the very best. And I'll talk to you soon, buddy.
Happy New Year. Take care, man.
Happy New Year, man. See ya.
See ya.
Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.